Hello and welcome to the Mutual Fund Show. My name is Neeraj Shah, and over the next 30 minutes or 25 minutes or 27 minutes, we'll discuss all about what's happening in mutual funds and what are the current key questions. The show, yes, is centered around balanced funds, and remember, we've got some of the queries, but if you have more queries during the show, please do write in to us as well. However, let's start off with the big question, and the big question on a move that happened about 4, 5, 7 days ago. About new valuation norms for money market and debt market securities, and whether that changes the dynamics for liquid funds, and even if it does it impact you as an investor? And then, of course, we'll get to the topic of the show, which is balanced funds. Ashish Somaya, CEO of Motilal Oswal's AMC, joins us right now on the show. Also be joined by Harshvardhan Rungta of Rungta Securities. Gentlemen, both of you, thanks so much for joining in. Ashish, a reasonably big change. Does it impact the life of an average retail investor, or would you reckon that those investors are better served by other categories and not necessarily liquid funds?
No, I think a lot of people, for their overnight requirements or emergency requirements, liquid fund is the safest in the industry, because by definition it would not carry any credit risk or any duration risk. So I don't think from a retail investor's perspective, they should still keep their surpluses in liquid funds, whatever is required in a 24-hour notice. But I don't think this is going to impact them that dramatically. Yeah, on the margins it does impact the fact that what maturity of paper the underlying fund would like to hold, so that their NAVs are not very volatile. But I think anybody who's investing even for say 7 days, 8 days, 10 days, I don't think it's going to change very dramatically.
Okay,
from their perspective, not really.
Okay. Harsh, did you get any kind of queries from your set of clients about what should they do, and what were your advice to them?
Well, not really, Neeraj. In fact, if you look at the changes in the liquid fund category, only the high-profile investors or the heeled investors or institutional investors would possibly be tracking it so minutely. When you look at retail investors, when you look at anybody who's investing up to say about a 50 lakhs or a 1 crore rupees for a period, for a temporary parking of money, really isn't bothered about this, because what are the alternatives? So if he was to keep this money in his bank account, it would earn about 3.5 to 4%. Against which, if anybody or any product is offering say about a 5 or a 6% in that case, it's good enough. Because when you're parking your money from a liquidity point of view, returns is not your objective. The idea is to also earn something, but have the accessibility to that money. So I don't think it's that kind of a concern, though. As much as it's trying to be made out of, but really there isn't much to this.
Okay. So, well, if you indeed read some articles, in fact, a couple of gentlemen wrote print pieces on our website as well. It may have an impact on certain categories of investors who might be investing big time into liquid funds, and the small changes or small basis point changes might matter, but both are experts out here believing that it doesn't really make a difference, too much of a difference. Okay, let's move on to the topic at hand then, and the key theme for the show, balanced funds. Now, the reason why we thought of doing this is because flows into balanced funds turned negative in January for the first time since May 2014. Ashish, quite a long period of time, and I remember when we started the mutual fund show, this was, I think, May a couple of years ago, so therefore May 2017, or thereabouts. At that point of time, everybody, and maybe for the right reasons, were talking about how balanced funds seem to be the place to be in.
Sure.
What has changed in less than 24 months, actually, about 20-odd months?
No, so I don't think I don't think the relevance or the product construct or anything has changed that dramatically. And when I say balanced funds, clearly there is one category which is dynamic and balanced advantage, wherein the equity exposure is calibrated in consonance with some or the other valuation indicators. And then there are balanced funds which are supposed to operate in a tight range of say 65 to 70% equity and the rest in. So I would say one is a variable allocation and one is a fixed allocation. And they are supposed to churn out returns and risk volatility in a certain measure, right? So I don't think anything has changed from perspective of construct or from change from that perspective. I don't think anything in the relevance has also taken a hit really. I think if you are saying 1 year of, if you're seeing the 1 year return of some of these category of products, what has happened is that when there was this huge flow which came into the industry, it was believed that this dynamic category or a balanced category is a great category for initiating people who are entering the industry. So look at it this way, a lot of people might be coming from the fixed income allocation kind of mindset or from fixed deposits or something, because after demonetization rates collapsed and that's what coincided with this huge flow. So I won't be surprised if a lot of people who were erstwhile fixed income investors have started now investing in this. So obviously these funds were probably positioned that they would give lower return than equity, but definitely they would cut the volatility by a very large margin. So they would be expected to deliver return in a certain space, which is much better than fixed income. And plus, of course, the whole deal was juiced up by saying that, okay, these funds will give dividends every month also, because that is also something which replicates the.
Yeah.
So if you are given a kind of feeling that you would do better than fixed income, but yet your cash flows are going to be taken care of by way of the payouts, then you enter with a certain expectation. And then fast forward to where we are right now. Before this humongous rally started in March, before that, if you see end of February, I think a lot of balanced funds had, say, zero return in the last 1 year. If you go back to 2017, like July 2017, August 2017, they might even be showing negative return in that time frame of 17, 18 months. So you come with a certain set of expectations, and then reality hits. In between, dividends were made taxable. In between, I've also heard of some funds not being able to keep up with the monthly payouts and skipping the.
Yeah.
So I think it's more the product category hasn't changed or the relevance hasn't changed. I think you got a bunch of people with a certain set of expectations, and those expectations are definitely being belied or not being met at a point in time.
Okay, so you speak at a lot of forums to investors, to potential investors, so on and so forth. Have people questioned this? And I'll get in Harsh on this conversation too later. But have people questioned this? That because I believe a common topic for conversation that used to come up about 6-9 months ago was the mis-selling of balanced funds as dividend-paying funds for perpetuity.
Yeah.
Does this come up too often?
So on a lighter note, I didn't use the word, but I said everything that you. But yeah, I mean, I don't think the word comes up in that sense that it is mis-selling. But clearly, it was there in the numbers. The delivery in terms of the volatility, in terms of beating fixed income, and in terms of the monthly payouts, the entire delivery and the track record actually demonstrated. It's just that we have hit upon a certain scenario where there is unprecedented, if you see a lack of correlation between large cap and mid cap, a lot of funds struggling to beat the, plus in a balanced fund, it's quite possible that you've taken a knock on the equity as well as the fixed income side, because last year, if you see the 10-year bond was all over the place, fixed income was all over the place. So I think it is more situational. And it's just yet another learning that, past indicator is not, past performance is not indicator of the future. So a product is bought based on some communication and certain expectations, and then obviously they are not met. So at some level, if somebody hasn't explained that, okay, this is what the past shows, but you need to prepare for these eventualities. Also, to cut some slack, nobody thought that, okay, dividends will be, because in our country, dividends are taxed at all levels. Now even mutual fund dividends are being taxed, which is quite unexpected. So some things are unexpected, and some things I think could have maybe been communicated much better. I think that's where the challenge is.
Do clients come up to you saying this? Maybe not your clients, but in conversations that you hear at conferences or otherwise that you must be going, that we anticipated a regular inflow of dividends because that's what we were told, and that's not happening, so we are disenchanted with balanced funds?
So if you look at the entire profile of an investor who came into investing into balanced funds with this monthly income as an expectation, was an unaware investor. Essentially, if you look at them, they've been those fixed income investors who have been, dissatisfied with the reduction in interest rates, with all those kind of stories going around otherwise. So equities, a portion being in equity, being a regular income product, I mean, this actually got them into the, so I have known people who have come and back tested something that has been suggested to them, saying that, is this true? On different various shows that we've taken all across different channels. So this has been a query that, we're going to get monthly income out of this, and the rate of return is also kind of indicated, saying that you will get about 0.75 to almost 1% a month. So all this has been mis-selling, as you rightly said. Now, putting that into perspective and seeing what has happened today, and 2018 being completely flat as a, in terms of returns for this particular product category. I mean, people have been, completely disgruntled with this. And it's very natural for them, at least this part of investor group, to actually move out. So I would again, just come back to this topic to say that there is a product which has been designed, and as a manufacturer, it's your responsibility to have a product category for all types of investors.
Sure.
The problem arises when something has been something else has been shown and given to an investor whom it's not suitable to.
Okay.
So manufacturer side, you need all kind of products. You need a balanced fund. You need as per the SEBI categorization, you need a conservative hybrid. You need an aggressive hybrid. So if a product has been designed by a manufacturer, it does not mean that it has been designed to garner some assets in under that particular category. It's as an option you're supposed to have it. Now the responsibility lies in the investor and the intermediary to actually place the right product to the right investor.
Okay.
So had that happened properly, I guess we would not be in this kind of situation and in this conversation right now.
So, no, okay. Well, I hope we didn't have to have this conversation right now, because that would have meant investors haven't lost so much of money. The question is, what's happened in the past is gone. I think on a number of occasions, we this show as well have tried to convey that don't expect dividends from these funds, because it's essentially your NAV that's coming back to you per se. What now, Ashish? I mean, what kind of investors should look to go out and invest in balanced funds? I mean, is there a particular categorization that you guys do in your minds, or otherwise for people who want to invest in balanced funds? And is there a particular category within the many categories that have been created, 16 plus 16, I presume, on the equity and the debt side, that might be a better serving category than balanced funds?
So I think on the first point, what I would like to clarify is that I don't think people will lose out money. I think the journey that they thought they would have versus the journey that they have had in the last, say, 18 to 24 months, I think there is a complete dissonance in terms of what was expected and what came out. But eventually we have the belief and confidence that these guys will not really lose out. They might have come into a product expecting something and might have come into a product for the wrong reasons, but I don't think they'll end up losing money. It's just that the journey is not as nice or smooth as it should have been. Also, I think in the last few days, I mean, we not want to get carried away with short-term occurrences, but I think in the last few days there has been a recouping of values in some sense, because of what you've seen in the market. So I'm happy for the people who were actually really monitoring their investments that closely and who were worried. Coming to your point about, I mean, the product frankly is still relevant, because if you are, let us say, one of the things in this whole hybrid or balanced category, like I mentioned, is these dynamic funds or balanced advantage funds, which actually calibrate the move, right? So when balanced funds at -5 or -10, a lot of these dynamic or balanced advantage funds were maybe at 0 return or -1 or +1 or something like that. So obviously the impact was, they braced for the impact. So the category is very, very relevant. There's no doubt about it. It offers a risk-return combination which lies somewhere in between fixed income and equity. So there are stepping stones. So what type of investor is it relevant for? Is someone, okay, two things. One is that there is someone, okay, who is not doing his asset allocation with his advisor or himself. He's not doing the asset allocation on his own. So how much equity, how much debt, blah, blah.
Yeah, okay.
But maybe for better experience or simplicity, they want to buy one product which is multi-asset, right? And who are looking for equity exposure but with lower volatility. So there is a market out there. It is a relevant product. I think what to expect out of it should be very, very clearly understood and communicated.
What do you tell the large swaths of people who would ask about whether they should go ahead and invest in balanced funds or pure play equity funds? And then, of course, we'll come to the kind of people who should invest in balanced funds specifically. But here on, as a CEO who's addressing so many investors, with the way the markets are shaping up right now, and into your minds, to your house, the way their markets are expected to shape up, what's the advice that you give?
So we do have a dynamic category fund, right? And we, in fact, in October, we created a equity hybrid, which is now balanced. Balanced, you can't call it balanced, it's called equity hybrid now, right? So we have funds in those categories, but we don't pay monthly dividends. We, in fact, encourage people to understand this concept of withdrawals or a systematic withdrawal. Like, okay, if you expect the underlying asset or the underlying fund on a hybrid basis to, let's say, grow at a rate of 10%, okay, and let's say you set a withdrawal rate of 0.7 per month, right? So you're withdrawing at a rate of 8.5%. Let's say you stay invested for 5 years. So in 5 years, on an average, the fund grows at 10% CAGR, and you have consistently been withdrawing a fixed rate of 8.5%. Then you're not going to break capital. You're going to preserve your capital. You're going to meet your cash flow requirement. You're going to get a return better than fixed income. Because, this whole dividend thing is actually quite misleading, right? Because when I say dividend, you think that you're supposed to get it, it's your entitlement. It's actually not. You explained all of that. Plus, dividends are not in anybody's control. It's the fund accountant or the fund manager who decides. And then this taxation and so many things. So from every perspective, and how do people plan for annuities? Right? I mean, the underlying asset is growing at a certain rate and you're paying out withdrawals at a certain rate. So it's a known concept. The only learning out of all of this is not to mix your return expectation with your cash flow. A lot of people are very, very confused. You have to segregate cash flow from return. So the underlying fund may give a return of 10-11%, but you take the cash flow at a rate of what you need the cash flow to be, and make sure that your withdrawal of cash flow is lower than the actual return that the fund has the potential to deliver. So we have these products, we are just trying to communicate differently. That's the idea.
Okay, interesting. You mentioned in your answer that it's a relevant category even now. For what kind of investors is this category even relevant even now?
So Neeraj, if we've always been advocating, even on this show, that you will want to have an asset allocation plan in place. So irrespective of your age, irrespective of how much risk can you take, we're advising investors to have debt and equity both in their portfolio. So one choice would be, like if you recommended a 70% equity and a 30% debt, suppose for an investor, there is one way to go about it, is to pick a 70% equity directly in an equity fund and put a 30% in a debt fund separately. Now, which means that you'll have to constantly rebalance this also on your own. So suppose you're looking at equity markets doing exceedingly well and debt being what it is doing in a normal way. So the allocation to equity will go up after a year. So if you have to come back to 70-30, you have to sell off equity, a portion of your equity, and allocate it to debt. Now this is a manual process. You will have to continuously do it yourself. And irrespective of however disciplined a person is, we've seen investors over a period of time tend to get overridden by emotions. So while we started with a 70-30 ratio, if equity markets are doing well, they will expect it to do much better later on, and they will forget the asset allocation that was originally designed for them. So a balanced fund in that, in that space, does this automatically for you.
True.
So if a fund manager has to allocate 70 and 30, he will automatically keep doing this internally at every level, so that 70 and 30 ratio is maintained. So for a person who wants to automatically do this and not get involved himself, then I think a balanced fund is a very good category to be in. Just get one product and you're sorted for that asset allocation bit. The second category of investors would be, again, those who are trying to explore equity. They're trying to venture into equity investing, but they're not confident of putting entire money at one shot. So then you have the conservative hybrid products. Okay, we're not talking about the efficiency on the taxation part, but let's just understand then investor profile. So if a person has been a fixed income investor all the while, and then you're telling him that this is not going to help you beat inflation, just by itself, debt is not going to help you create wealth. There has to be some equity allocation, so which could be 10%, which could be 25%. So now again, the reverse calculation is then, do you actually do it separately yourself, or you have a product designed and kept for you? So which is a conservative hybrid product, which will have an equity allocation of up to say 25%. So in that case, you would want to venture into this, okay, and test your, the markets, test your capability to absorb the volatility and to understand what is happening. Okay, and then you increase your equity allocation. Then you move to an aggressive hybrid, and then move to 100% equity later on. So again, just re-emphasizing on that point, that as a manufacturer, I mean, it's your responsibility rather. I would not say it's a privilege or it's something that you're doing, wrong.
Sure.
It's your responsibility to make sure that you have a product which is catering to different kind of investors. Because if an investor wants a 10% equity allocation, and if you don't have it in your basket, then actually you're not doing justice being a manufacturer. I would put it that way.
Okay.
At the same time, if a person wants a 70% equity and a 30% debt, though he has a choice to do it separately himself, he may want to just take one product and sort it out himself.
Okay. Okay. So we'll take in some queries as well in just moments from now, but just one question to Ashish. Ashish, in a scenario like this, I mean, that's what I come back to now. So let's assume that there is a relevant market for balanced funds as well, but with the fact that, or with the belief that equity markets, the way things are showing right now, will not have too much of an adverse time over a 2-year period or a 3-year period. And I hear a lot of you say that over a 5-year period, equity investing would be the best investing, right?
Yeah.
And you guys pride yourself on that. Think equity, think Motilal Oswal. Would you reckon that somebody who's got a slightly longer term horizon, there's no need for this, just go into pure play equity funds?
Yeah, I think the need for this, people would realize, look at it this way, that we have certain set of beliefs and certain expectations, and I concur with what you mentioned about a 5-year time frame, or even the current context being quite positive. So I concur with that.
It looks like that right now.
No, I'm also pretty positively inclined. But the reality is that when people are signing a form and cutting a check, they are all long-term investors. But when it actually plays out the journey, then the long term is out of the window, and then it's a different set of emotions and thoughts driving the whole process. So what happens is that when there are people who cannot take downside beyond a point, even at the cost of capping their upside, then of course they need certain risk-return combinations. Because in a 5-year journey, equity would do really, really well, and maybe even the immediate prospects might look very bright. But definitely somewhere down the line, we will have periods which will be not that great, and we will see a capital correction. So it's a question of what people can tolerate. I think that's why we need all these combinations.
Okay, interesting, fair point. Let's take in some queries. Time permitting, we'll take more, but maybe we'll take a couple of them for sure before we wrap up the show. Harshal writes to us on Twitter. He wants to invest in funds that help in tax savings and generate decent returns at a current point of time. Now, I can ask Ashish about funds in his house, and then I can ask Harsh about funds that overall category as well. Who wants to start off?
Yeah, maybe Harsh can advise.
Harsh, you want to start off?
Yeah, so clearly he's looking at an ELSS fund because it's a tax saving season right now, and I'm sure there are deadlines for those investments to go through. And so yes, ELSS is one category, but just before we get into naming products, I want to highlight this to all investors that whenever you invest your money, understand why are you investing. Tax saving could be another advantage that you get with it, but you don't invest in a product just because you want to save tax. So ideally, if Harshal would want to invest for his long-term goals, which is say probably 10 or 15 years away at least, then equity is an asset class to invest into. Now within equity as an asset class, he wants to also save tax. So then ELSS is a product. In case he cannot take risk, or his goals are not he's not an equity market he's not comfortably investing in equity markets, then debt is a side that he should look at. So probably a bank fixed deposit would be also giving him tax benefit, but that's the product he should be investing into.
Okay.
So first understand what is your risk profile, and there is a tax saving product for every category of investors.
But he seems fairly confident about tax saving funds. So what would you recommend?
So in this case, he could of course pick up the Access Long-Term Equity Fund. He could pick up the Birla Tax Relief Fund. So these are have been in existence for long. They have demonstrated that they've outperformed at all levels, and so this is what you can he could consider investing into.
Okay, Ashish, I believe you guys have a product like that too in your stable. This is, I think, the long-term
equity fund. Yeah.
Okay. Any thoughts on that fund? How is it done, and what is the outlook looking like, etc.?
No, so I think it's done pretty well because we started, but I think it doesn't come into a lot of filters because generally funds come up in these ratings and rankings once they finish 5 years. So we created our fund sometime in 2015, and it's just about in January finished 4 years.
Okay.
So for the time that it has existed, it's a multi-cap tax planning fund. Obviously, it has all the tax benefits that any other fund would have in the category. I think since the time it's got started, it's right up there in terms of the numbers. So it's done pretty well. But yeah, I concur with what Harsh mentioned, that tax saving needs to be looked at in a fundamental manner, that the government of India is telling you that it's good to save for your goals. And if you save for your goals, then I'll give you some rebate from your income. So I'll allow you some income to pass without taxing it. So they are just trying to incentivize right behavior. But we live in a country where if you say that you're going to get tax benefit, people put their money anywhere actually. So the point is you need to know why you are doing it. Tax benefit will anyway flow through.
Okay.
One point I'd like to highlight here about, not because Ashish is here of course, Motilal Oswal otherwise has been a very known equity research desk. So I mean, and I'm happy that at least they demonstrate themselves to say that we are equity, we understand equity. So and very slowly and gradually move into debt. So in that case, from any equity investor point of view, Motilal Oswal can be a fund house to definitely look at.
Okay.
Purely based on the equity research, capabilities, which is well appreciated all across the industry, by the way.
Okay, cool. So that's the word. I hope you got your answers. We have very little time, but maybe taking a couple of other queries. Deepak writes to us on Facebook. He wants to know that most large caps, actively managed funds underperforming the benchmark in the last 1 year. Do you think passive investing makes sense? I can give that answer too, but I'll let our guests do that. Ashish, you want to come in on this?
See, I think there's no debate about this, that for long periods of time, for any kind of size of portfolio, one can consistently keep beating the index. The jury is out on it, but there is experience in the Western world which says that yeah, it's not sustainable for a long point in time. In India, I think it's too early to make those conclusions. There are a lot of people even in India who don't agree with what I'm saying, but I sincerely believe that it's very, very early in India to make these conclusions, and don't go by what happened in the last 1 year. The reason being that if you see from the bottom of demonetization till now, Nifty is some 50% up. The small cap index went up and has retraced completely. It's back where it was. The mid cap index is, I think, 10% above the demon bottom. And we are not buying pure large caps. Our funds are multi-cap or focused category or whatever. So we have combination. So if you are benchmarking with Nifty or Nifty 500, which is again 81% large cap. So there has been a huge divergence in the market, which is quite unprecedented. I don't think this underperformance is going to last for long. I think we are going to cover it up. It's just that the market behavior has been very, very unusual in the last 1.5 years. Also keep in mind that, we are living in a country where most, I just feel that when we talk passive active in our country, we are very worried about the index capturing the market return before the market has started capturing the whole economy itself. Right? We are living in a country where banks are coming for IPOs, and the first insurance company got listed last year. So I am not yet ready to believe that if I'm managing a multi-cap fund or a mid-cap fund or a small-cap fund, that I won't be able to beat the index. I don't think I don't think it's too early to conclude that based on what happened in the last 1 year. That's what I would say.
Okay, point well taken. We have quick 2 30-second answers from you, Harsh. Firstly, to your clients, do you recommend passive funds at all, or are you largely on the active funds?
No, in fact, we've been an active, advocate of passive funds. I mean, of course, the allocation is not 100% as of now. So we've been talking about passive funds since about, I guess, about a decade now. Okay. And we've been recommending an allocation of about 25% into passive funds.
Okay, so that's the answer. I hope you got the answer depending on which suits you. I think there's no doubt that active investing would probably still be able to do it. Harsh believes that there could be some allocation that can be done to passive as well. Before we wrap up the show, since the topic was balanced funds, and the rule is that you cannot recommend a fund from the Motilal Oswal stable, but if you were to recommend funds from that category, 1 or 2 funds that you would advocate people to get into? Yeah,
so I'd pick the ICICI equity and debt fund. I'd pick the HDFC equity hybrid fund and a Canara Robeco hybrid equity fund.
Okay. Jaman, out of time completely. For more queries, viewers, you will have to write in and we'll try and get these guests to answer. But appreciate you taking the time out and joining us on the show today. Thank you so much for being with us. And viewers, thanks for tuning in to this leg of the Mutual Fund Show. Stay tuned to Bloomberg Quint Live.